Welcome back, ladies and gentlemen. You're listening to another edition of DIY Money.
DIY Money.
Have I told you, I think
Nope.
I did bring this up, that I am running training now for, did you just crack yourself up? Look at you. You're like, nope.
Nope.
For the New
Betting that
York
you haven't.
City Marathon,
Yeah.
November 7th.
2 episodes ago.
Yeah. Anyways, I'm training for it. I'm excited. I'm running with an organization called Achilles International. They support athletes with disabilities. I'm pretty pumped about that.
Cool.
That's right. We couldn't come up with the 5 boroughs. Let's try that again. Brooklyn.
Did you Google?
Staten Island. No. Long Island. Manhattan. Queens. Wait. Where's the Bronx? One of those is not. Yeah, whatever. Somebody send. I'll
Brooklyn.
Google it. Brooklyn. Bronx.
Same thing?
No.
No?
Bronx is north of the city, where
Okay.
the Yankees
I'm not
play.
from New York, so I
All
have
right,
no idea.
Let's go. Let's move on here. We got a great question from Jamie. We're just going to skip all the fodder and go right to Jamie. Jamie, what do you got?
Hi, Quint and Daniel. I love your show. I listen to every episode. I'm 39. I have a master's degree and work as a support engineer. My husband also works as a software engineer, and combined we make about $250,000 per year and are able to save about $5,000 per month. We're finishing up paying off a car loan in the next 2 months. It will be paid in full, so yay. It should also take us about 4 months to build up our emergency fund. Afterwards, we will only have student loans and our mortgage left. My question is whether we should pay off the student loan next or pay off the mortgage. We have about $150,000 in student loans at a 6.8% interest rate. And with the mortgage, we owe $358,000 with a 3.5% rate on a 30-year term. My husband thinks we should do the mortgage first so that we'll be mortgage free. As I mentioned, we can allocate $5,000 per month towards either of these. So we just need your advice on which one we should tackle first. I look forward to your great feedback, and thank you so much. Again, we love your show.
Okay, phenomenal questions. This theoretically could end up being the shortest show we've ever cut. I won't do that, but for me at least, this is a no-brainer, an absolute no-brainer. You attack the student loan debt first. And let me explain why. There's a variety of reasons. And then I'm actually going to take a stab at why I think your husband is suggesting the mortgage debt. We don't have a husband name. Let's call him David.
Cool.
David. I'm going to say why David, I don't know if it's David. Sorry if it's not David, Jamie. I'm going to say why David thinks he should take the mortgage debt out first. So, first and foremost, it's a 6-point-something% interest rate, well above the 3-point whatever you have on your home. By the way, probably maybe you've already done this already, but look at refining. Believe it or not, rates have probably gone down another percent, and you might be able to save a significant amount of money on your primary residence. That's number one. You're paying a significant amount of interest on your student loan over and above your mortgage. Number two, deduction, interest rate deduction. On the home mortgage, you're not getting a deduction on your student loan. Number three, you have a smaller student loan amount balance than you do the mortgage. Now, I know these are big, big amounts, and so the debt snowball thing might be a little bit different, but the reality is when you start attacking that student loan at $5,000 a month, boom, do the math. 2.7 years or thereabouts, that sucker's going to be gone, all right? So within 3 years, your student loan at $150,000 is going to be out the window. Celebration, boom, mic drop. Okay, so let's recap. Number one, interest rate is higher. Number two, no deductibility on the student loan. Number three, the ability to pay it off is much quicker using the $5,000 a month than the mortgage. Thereafter, chunk it down on your mortgage. Absolutely great. However, Daniel, no, what'd I call him? David.
I'm Daniel, by the way.
Yeah, you're Daniel. David wants to pay the mortgage off because there's a security idea there that with no mortgage, our house is paid in full and you know, we can't lose the house ever. I get it. I understand. But it's a very, very big price to pay for that false sense of security. Let's just look at some round numbers, shall we? $300,000, 3%. How much in interest? $9,000 a year. $150,000, 6% in interest. How much?
Same.
$9,000 a year, right? So, bottom line is, I can't do the math now because you're going out more than 3 years. If you don't tackle that student loan, instead, you go ahead and tackle the house and pay the minimum on the student loan, those thousands and thousands of dollars. And look, you're a support engineer, Jamie. You could do the math here. You are going to pay thousands and thousands of dollars in extra interest on your student loans by the time you pay off that house, that mortgage balance. And by the way, taxes, insurance, they're not going away. So understand, make sure that Chris, what's his name again? David, make sure that David knows the actual amount that would go away. Many people are shocked when they look at their balance and they go, oh, we wouldn't have this $2,700 a month payment. And then guess what? When you factor in taxes and insurance, you still have $1,500 a month in a payment. You may pay it all at once at one given time, a given year, but it's not this idea that it's all gone. This is a no-brainer for me. Pay off the student loans.
Yeah, I mean, there's a couple, when you're looking at debt, there's a couple methodologies and mentalities. Combine those into one word.
I like it.
Yeah, trademarked. But anyhow, there's the snowball, which is take the lowest balance. And especially if you have a series of debts, you start with the lowest balance and then you snowball up, you roll the payment from one into the next one and so forth. So if you're doing a snowball, you would go with a student loan because of $150,000 balance versus $358,000 or something of that nature in the mortgage. Now, if you went with the mathematical option always typically says start with your highest interest rate first, regardless of the balance. Over the course of time, you're going to pay less interest overall, then you'll actually pay off your debts quicker. Well, if you went with the mathematical solution, you would pay off the student loan first and then go to the mortgage because your student loan's at a 6.8% interest rate, and you said mortgage was, I think, 3.5%. So really, whichever method that you went with, as far as the common methods go, it's going to lead you to the student loan first. Yeah, the mortgage, paying that off, it's going to take longer than it would the student. So here's where I would pay the mortgage off first. If the mortgage balance was like $50,000 and you could knock that off in a year, and then you're like, okay, then you do the snowball method because you're doing the one with the lower balance. The student loans, depending on what type of student loans you have, I mean, a 10-year, if you're in a standard government student loan, a 10-year repayment, you've got a, $1,700 a month, roughly, payment that's going to knock off in 2-point-something years. Freeing up basically $7,000 a month.
Right, the 5 they're putting in plus that
yeah,
amount. And then you're paying off your mortgage. What about the idea, because we hear this a lot, and this might be what David is also thinking, is that they're going to forgive those student loans?
Could happen. We've talked about it on the show a couple times. I wouldn't bank on that happening. If you have the opportunity to pay, I wouldn't put all my eggs in that basket, especially with this high of a balance. So far, the administration has not shown that they're willing to go this high. Well, I guess we don't know how that's divided.
If they do it at all, ever, I think it would be a cap at like $50,000.
Yeah, and even that's
a lot.
Significantly high from what they've been floating
And
around,
why?
So.
I'll tell you what. This is a different, maybe subject for a different day. But I personally would have. I would be involved in the group that has a very, very hard time accepting that from our elected officials. And the reason is that my wife and I paid off over $50,000 in her student loans. I got to work on that. Our student loans. Because if all of a sudden people are getting them forgiven and we paid off $50,000 in our student loans however many years ago, where's our credit? Where's our, where is that ability? And so there's going to be a lot of pushback there on either side. And I know a lot of people don't agree with that. I know that we have a lot of listeners that just totally disagree with what I said, but just telling you from my perspective.
Yeah. A couple other variables on the student loan that could come into play, but it doesn't sound like from the limited information we have that they would. Public student loan forgiveness is an option for some people who are doing public service for 10 years. But you would have to have consolidated and be on a 20-year repayment because it's a 10-year timeline to the public student loan forgiveness, and the standard payment is 10 years. So typically you would have been consolidated into a lower payment. The other option is if you had an income-based repayment, but at the incomes that you stated, I don't think that's going to be the case.
Nope.
I don't think that's going to have brought down your payment at all. So if
Pay it off.
Yeah, if you made me guess, I would say your payments somewhere between $1,000 and $2,000 a month. If you can get that paid off in 2.5 years and have $7,000 a month that you can either put towards the mortgage or investing or just basically achieving your goals.
And you still, Jamie's 39, she said.
Mm-hmm.
So you still, by, maybe late 40s, you have the potential to pay off the mortgage as well. So again, the idea of, hey, we're totally debt and mortgage free, you still have the ability to claim that at a very, very young age.
Yeah, I would, when you get to that point, when the student loan is paid off and you start looking at that mortgage, at that point, maybe talk to somebody, a planner that can help look objectively at the goals, because at that point, what you could also end up inadvertently doing is paying off relatively low interest rate mortgage for the next 5 years, but not really attacking some of your other financial goals. So just keep it all in balance. At that point, you're going to have a $7,000 a month surplus. I would allocate a little bit of that to just getting an objective set of eyes on your goals, somebody that you can trust, and then taking it from there.
Maybe our wealth development program. Is that what
Could
you were
do
doing
that.
there?
Well, yeah, I mean, if she wants to utilize us, but I mean, there's other great options, but I think we do a fine job.
Fine job. All right. That's about the extent of you'll ever hear Daniel market our services, is that little subtle sly there. All right, let's recap a few things. First of all, Jamie, great question. Keep up the unbelievable work, and thanks for sending that in. We'll send you a $25 Amazon gift card. And I hope you celebrated. I know you probably sent your question several months ago. I hope they celebrated the car payoff.
Me too.
Go out to dinner, split an appetizer, happy hour, keep it within budget. Celebrate those wins. All right, remember, friends, the secret to wealth is very simple. Live on less than you make. Invest the rest. Do so for a very long time. Make it a great one.